Investigation from payroll.org established that approximately 49% of compensated American populations indicated that singular week compensation postponement would generate substantial management difficulty. An additional 28% characterized circumstances as moderately challenging. Combined representation encompasses 77% of compensated American workers, demonstrating insufficient reserves for 7-day income interruption situations. Bankrate's 2026 Contingency Reserve Investigation documented 24% of American populations maintaining zero contingency reserve funds. Approximately 59% demonstrate incapacity addressing $1,000 unanticipated expenses without debt accumulation or asset liquidation. These statistics don't exclusively characterize lowest compensation earners. The phenomenon manifests throughout income classifications, educational backgrounds, and professional categories. Goldman Sachs' investigation determined 41% of Americans receiving $300,000 to $500,000 annually report perpetual paycheck-dependent existence. The fundamental difficulty transcends compensation quantity considerations. Rather, the difficulty concerns what transpires between compensation arrival and subsequent compensation receipt timing. Typical compensation recipients demonstrate behavior comparable to liquid flowing through hand openings. Compensation materializes, subsequently becomes absent, while recipients cannot articulate a destination. Expense levels approximate 30% greater magnitude compared to 3-year previous pricing. Inflation-driven change has restructured compensation purchasing capability fundamentally. This presentation offers meticulous guidance regarding compensation handling throughout 2026. Implementation sequence demonstrates greater significance than most populations recognize. Following this specified arrangement produces wealth construction, while surrounding populations experience ongoing financial constraint, despite equivalent compensation amounts. The foundational component precedes all remaining monetary management actions. Execute minimum amount compensation toward all obligation categories: credit obligation payments, advanced education financing, vehicle acquisition payments, merchandise acquisition payment arrangements, medical expense distribution plans. Whatever monthly recurring commitments exist throughout financial circumstances, minimum payment requirement receives initial priority designation. Conceptualize this as fundamental survival operation. Advancement progress hasn't commenced. Movement trajectory toward resolution hasn't been initiated. Rather, head position remains elevated above submersion point, preventing drowning circumstances. Overlooking singular payment obligation generates credit evaluation damage. Deteriorated credit ratings establish extended duration financial complications, with multiplying consequences. Reduced credit ratings produce elevated borrowing expense percentages and heightened insurance expense percentages throughout numerous territories. Credit evaluation calculation incorporates 5 component elements, with superior importance elements dominating computational methodology. Transaction execution history comprises 35% of evaluation calculation. Debt amount relative to obtainable credit comprises additional 30% of evaluation calculation. Combined, these components comprise 65% of creditworthiness determination factors. Conclusion logic demonstrates straightforwardness. Consistent temporal execution of compensation obligations, combined with reasonable debt, relative to credit management, produces automatic evaluation maintenance. No specialized methodologies require implementation. Lending institutions universally provide computerized payment functionality. Activate this functionality. Subsequent phase deserves independent classification status due to amplification effect on remaining procedures. Institute computerized financial movement systems. Establishing computerized transfer systems spanning every subsequent procedure stage might represent singular most advantageous financial action accessible. Computerization eliminates willpower requirement from circumstance equation. Psychological mechanics remain straightforward and empirically substantiated. Funds remaining absent from observable possession cannot undergo spending behavior. When computerized transfers occur preceding checking account arrival, reliance on post-employment exhaustion discipline capacity terminates. Monetary movement precedes circumstance factors. Integration occurs seamlessly throughout appropriate account distributions without demanding conscious deliberation beyond primary configuration. Investigation from government-supported retirement programs substantiates this methodology effectiveness. Employment participants utilizing computerized payroll deduction savings demonstrate substantially elevated continuation probability compared to individuals attempting manual transfer procedures. Exceeding 1 million employment participants have accumulated surpassing $2 billion throughout state-operated automatic IRA programs. Approximately 92% of compensated Americans currently utilize computerized compensation distribution. Infrastructure requirements for computerization systems already exist. Most financial institutions and investment providers facilitate scheduled recurring transfers specifying amounts and execution dates. Technical obstacle requirements approximate zero magnitude. Allocate 15-minute intervals, post-content consumption. Examine comprehensive procedure. Outlines throughout this framework. Institute computerized monetary distribution toward appropriate account classifications, reflecting personal circumstances. 15-minute preliminary setup investment generates lifetime span returning advantages. Subsequent procedure stage finances monthly operating requirements encompassing fundamental requirements and unquestionable expenses, maintaining life functionality. Dwelling payment obligations. Temperature control expenses incorporating electrical, fuel-based, aqueous, and digital communication provision, nutritional product acquisition, health management expenses, transportation requirement expenses, protection policy expenditures. Calculate actual monthly quantity with precision orientation. Imprecise approximations demonstrate insufficient effectiveness. Dwelling payment approximates $1,750. Temperature management expenses approximate $300. Vehicle transportation expense approximates $400. Protection policy expense approximates $150. Nutritional product acquisition approximates $500. Extra requirement expenses approximate $300. Resulting monthly operating requirement approximates $3,400. This quantity necessitates continuous checking account retention, sheltered from discretionary spending patterns. Incorporate marginal quantity buffer, exceeding calculation precision, perhaps $300 to $500 supplementary, since actual experience rarely matches numerical projection models. The 50-30-20 framework demonstrates compatibility throughout comprehensive income classifications. 50% of compensated income addresses fundamental requirements. 30% addresses preference expenditures. 20% designates toward accumulation and financial expansion. Frequently overlooked clarification. Monthly operating requirement exists completely separately from contingency reserve funds. Operating requirement addresses anticipated recurring expenses. Contingency reserve addresses unanticipated disruption circumstances. Subsequent procedure stage constructs, contingency reserve funds. Contemporary guidance recommends 4 to 6 month duration contingency quantities, responding to amplified economic instability, widespread employment termination events throughout numerous business sectors, and enduring inflation consequences. Presuming monthly requirement approximates $2,500. Contingency reserve target range approximates $10,000 to $15,000. Solution methodology involves sequential target establishment. Accomplish $2,000 quantity initially, subsequently $5,000 quantity, subsequently $10,000 quantity. Every achievement milestone generates momentum acceleration. This account category undergoes funding priority preceding consequential investment commitment and accelerated obligation elimination. Contingency reserve funds prevent comprehensive financial structure collapse when unexpected circumstances manifest. Contemporary contingency reserve documentation demonstrates sobering patterns. Bankrate's 2026 information documented 24% of American populations maintain zero contingency reserve savings quantity. Additional 30% possess certain quantity savings, yet insufficient for 3-month expense coverage. Account storage location demonstrates substantial significance level. Federal regulation standard savings. Account return rate approximates 0.39%. Higher yield return savings accounts through internet-based financial institutions currently provide 3 to 4% yearly return percentage, while certain accounts maintain return percentages surpassing 4%. Contemplating $15,000 contingency reserve quantity, standard savings. Account methodology. Earning 0.39% generates approximately $58 yearly compensation. Higher yield return account, approximating 4%, produces $600 from identical quantity amount. Identical money, identical protection guarantee, tenfold return magnitude disparity. Subsequent procedure stage initiates authentic wealth construction activity. Finance retirement-oriented accounts. Baseline level contribution represents 10 to 15% of compensation amount toward retirement account funding. Investigation regarding wealth accumulator behavioral patterns persistently demonstrates wealth construction practitioners finance minimum 15% prior to extra expense accommodation. Retirement contribution funding receives mandatory status classification. 401k account financing authorization increased to $24,500 yearly amount for under 50-year participants. 50-plus year participants can supplement additional contributions achieving $32,500 total. First priority involves contributing quantities, capturing comprehensive employer matching contribution. Circumstances where employer matching delivers 50 cents per dollar compensation up to 6% and personal contribution measures merely 3% represents abandonment of complementary compensation. That matching contribution establishes a guaranteed 50% return rate predating market gain activity. Originating timing demonstrates greater significance compared to virtually all alternative elements. Allocating 10% of $75,000 compensation amount signifies $7,500 yearly contribution quantity. Consistent contribution distribution pattern across 40-year duration within diversified market index security portfolios, approximating 8% yearly return amount, produces approximately $2,100,000 retirement quantity. Individual retirement account authorization limits additionally experience 2026 calendar year modification. Yearly authorization limit increased towards $7,500 amount. 50-plus year participants can supplement additional $1,100 contribution quantity, achieving $8,600 total. Healthcare savings account authorization amount consideration deserves substantial attention level when accessible through high-deductible health coverage options. Contribution amounts receive taxation deduction treatment. Portfolio growth demonstrates complete taxation exemption status. Medical expense qualified distribution amounts receive complete taxation exemption status. 2026 yearly healthcare savings account authorization limits approximate $4,400 amount for individual participants and $8,750 amount for family unit participants. Subsequent procedure stage addresses elevated interest obligation elimination methodology. Elevated interest obligation classification encompasses anything approximating 15% plus yearly interest rate level. Credit obligation products almost universally satisfy this classification standard, averaging 20% plus yearly interest rate levels. Debt elimination approaching 24% interest rate demonstrates financial equivalence to guaranteed 24% investment return achievement. Elevated interest obligation elimination represents most proximate comparable approximation to assured success probability available. Dual primary elimination methodologies exist. Avalanche classification approach prioritizes elevated interest rate obligation regardless of quantity magnitude. Snowball classification approach prioritizes smallest quantity obligation regardless of interest rate level. Quick obligation elimination accomplishment materializes. Accomplishment satisfaction develops from complete obligation removal. Momentum building process advances. Recognize which methodology approach aligns with actual behavioral patterns. Both approach categories produce wealth-accumulating individuals. Selection divergence reflects psychological comfort preference. Lower interest obligation can coexist concurrently with investment activity participation. Stock market return average approximates 8 to 10% yearly performance across extended durations. Yet, singular monetary unit allocated toward 4% obligation elimination produces guaranteed 4% return certainty. Psychologically optimized selection for substantial populations involves complete obligation elimination, regardless of interest rate designation. Subsequent procedure stage expands investment participation beyond employment-affiliated retirement accounts. Following procedure stages 1 through 5 completion achievement, priority implementation sequence demonstrates: initiate employment affiliate matching contribution, capture, optimization. Subsequently, optimize individual retirement account, authorization, maximum achievement. Subsequently, resume employment-affiliated retirement account, contribution expansion, or institute, personal investment account. Establishment. Individual retirement account. Roth classification deserves heightened attention level due to distinctive taxation methodology treatment. Portfolio growth demonstrates complete taxation exemption character. Retirement stage, withdrawal periods involving decennial plus duration, produce zero taxation obligation. 2026 yearly authorization permits $7,500 contribution amount for under 50-year participants. 50-plus year participants authorize $8,600 total contribution amount. Personal investment account consideration involves unspecialized investment activity, demonstrating absent special taxation advantage characteristics, absent contribution amount ceiling restrictions, complete penalty, absent access capacity. Taxation consideration demonstrates planning importance level, 1 year plus, holdings periods preceding sale execution timing encounter, ordinary income percentage level taxation. Exceeding 1 year duration, holding periods, achieve long-term capital gain percentage level taxation designation, approximating 0 to 20% range. Fundamental recognition surpasses optimization emphasis. Consistent investment activity implementation, despite imperfect allocation selection methodology, demonstrates substantially improved lifetime outcome generation capability versus awaiting flawless circumstances manifestation. Subsequent procedure stage transcends conventional planning framework, approaching earnings stream diversity expansion methodology. In key magazine investigation determined 65% of independent wealth accumulators maintained minimum 3 revenue categorization sources. Tom Corley's 5-year investigation duration determined 45% magnitude achievement of 4 revenue sources, 29% magnitude achievement of 5+ revenue sources. 2026 operational environment demonstrates singular earnings. Source reliance pattern introduces greater risk magnitude compared to any proximate historical reference period. Technology sector employment reduction activity persists across major operation institutions. Machine learning applications. Technology orchestrates comprehensive industry reconfiguration with unpredictable consequence patterns. Diversification strategy delivers investment portfolio disruption protection simultaneously with income circumstances disruption protection. 1 to 5 hour weekly duration allocation approach toward organized activity development can generate $100 to $500 to $1,000 supplementary monthly compensation. Compensation growth scenario, lifestyle inflation. Prevention methodology activates at every earnings amount, increase event. Compensation amount growth realization mandates minimum 50% supplementary compensation allocation toward accumulation activity prior to lifestyle alteration implementation. This singular behavioral implementation pattern prevents lifestyle expansion phenomenon. Multiplication consequence demonstrates lifetime and extended period manifestation. Individual compensated amount approximating $65,000 pursuing this procedure. Framework accumulates substantial wealth quantity across 30-year duration. 15% conservation level produces approximately $813 monthly investment distribution quantity. 7% averaged return rate across 30-year period duration achieves approximately $920,000 result quantity. Incorporate employment affiliate matching contribution amounts, compensation amount growth history, directing 50% allocation toward contribution expansion and taxation advantage calculation reduction. Investigation documentation persistently substantiates this methodology pathway. Ramsey Solutions determined 79% of wealth accumulators demonstrate self-creation characteristics, demonstrating inheritance absence. Merely 31% achieved $100,000 plus yearly compensation average. Typical wealth accumulator accomplishment achievement required a 28-year duration period of consistent behavioral implementation. Maintenance. Procedure framework demonstrates absent glamour characteristics. No mysterious investment opportunities manifest. No market timing manipulation approaches surface. Framework guideline structure. Computerized implementation systems. Behavioral consistency maintenance, straightforward financial management discipline. Implementation manifesting every compensation reception event constitutes foundation element. Majority of compensated American populations demonstrate incapacity for singular weak compensation, interruption, survival, capability. Contingency reserve absence characterizes circumstances. Employment continuance manifests until physical incapacity achievement. Procedure framework methodology separates your position from that majority classification. Forthcoming compensation arrival manifests momentarily. Singular question persists. What conduct approach occurs at compensation arrival moment? Execute procedure methodology every compensation reception iteration. Wealth construction emerges through this methodology.